Hello, everyone, and welcome to this month's Investor Academy session. I'm Sarah Turner, and I'm joined as usual by Angel Academy co-founder Simon Hopkins and our network manager, Michelle McQueen. And of course, our brilliant speaker, Mark Pattenden, who's tax partner at haysmacintyre. EIS, the Enterprise Investment Scheme, is a really important subject for both investors and entrepreneurs. £2 billion each year is invested by private individuals directly into young businesses under the EIS scheme. It is the largest source of pre-seed and seed stage funding in the UK. So it literally drives early stage investment. As usual, to talk to us and ask questions, please use chat. But before we get going, just a little bit about us. So Angel Academy exists to close the gender gap in startup investment. That's both the lack of investment going to female founders and the low number of women angel investing. We've been doing this since 2014, and in that time, we've backed 43 businesses, many through multiple rounds. So we have more experience than anyone else in female investment in the UK. The businesses we've backed have raised over more than £100 million between them from angels and VCs, employ many hundreds of people in high quality jobs, generate millions in revenues, and many have social purpose at the heart of their mission as well, around diversity, better healthcare, lower environmental impact, and so on. Simon and I are both angel investors ourselves, and we wanted to create an angel network that worked better for us, where new investors would be supported, where experienced investors could benefit from other perspectives, where we could do thorough due diligence but save time by sharing the work, a network that's transparent, respectful, considered, and one where it's track record rather than noise that creates high quality deal flow. And for entrepreneurs, a similar offer. The network is experienced and very high caliber. We're fair and transparent, so there are not going to be any nasty surprises along the way. Our thorough screening process means that most companies that pitch will get investment, and all but one did last year. Our structured processes mean there's a single point of contact for founders, and the journey to investment decision is clear. We want to make raising from individuals as streamlined as possible. A little bit about what we look for in investment opportunities. I think, as angel investors, we're investing our own money. So we have a lot more flexibility than VCs, but we still need return on investment. We don't need billion-dollar exits, however, but we do need to see the ambition to get £100 million or more. So we're looking for founders who prioritize growth. They need to be comfortable giving up some control of their business to shareholders, working alongside shareholders, that they want to exit within a decent time frame, and they're building an innovative or defensible business. We're really lucky to have some great sponsors supporting us. They advise us and the founders we back. If your company would like to get more involved, please let me know. But back to today's fun. I'm absolutely delighted to introduce Mark Pattenden, who's the tax partner at haysmacintyre. He's been advising us on tax matters, but mainly EIS for 7 years now. So he's really one of the leading experts on the subject. I have some conversations for him to kick off the conversation, but we have plenty of time for your questions. So please put them in chat as we're going along. Hello, Mark. Lovely to see you.
Hello, Sarah.
How are you today?
I'm very well. Thank you for inviting me to come along.
Oh, you're very welcome. Thank you for joining us. So very quickly, what is EIS?
EIS is a tax incentive scheme introduced by the government to encourage investors to help fund startup businesses. It provides, as I say, tax incentives for the investor, so income tax relief on your investment, and if everything goes right, a potential capital gains tax-free exit if the business is subsequently sold.
Thank you. I think just worth making the point again about 2 billion a year invested by individuals under EIS. 85% of angel investors use it. So it really is so vital for us. So just having a look at entrepreneurs at the moment, what is it that they need to do to get ready to fundraise?
As you say, EIS is an entrepreneur-led process. So the entrepreneur needs to make sure that they are operating an eligible business. And there are various things that I think we'll come on to a little bit later to talk about eligibility. But the other thing that entrepreneurs can do is apply for advanced assurance with HMRC. Now, this is a process which allows, by which the entrepreneur will tell HMRC, give them their business plan, their financial forecasts, and they basically explain what they're going to do and ask HMRC to provide what's known as advanced assurance that anyone investing in that company will obtain tax relief.
Okay, and if for entrepreneurs, if it's their first fundraise, they need some initial interest before they can apply for advanced assurance. Is that right?
That's right. HMRC was almost overwhelmed with the amount of applications that they were receiving for EIS approval. And what they've introduced recently is a requirement that companies should have written confirmation, expressions of interest, shall we call it, from potential investors to effectively demonstrate to HMRC that this is a viable fundraise and not just mere time wasting as far as they're concerned. And
this doesn't need to be committed. You said expressions of interest, isn't it? So it doesn't imply commitment.
It doesn't, no. As I think most entrepreneurs will realise that there is no guarantee of investment until somebody actually transfers the money. So it is an expression of interest. Somebody is basically saying that they are interested in investing in this company. Generally, from our experience, it only needs a handful of such letters from the investors to the company as part of the advanced assurance pack that would be submitted to HMRC.
I think we've just a recent case, just given 2 names and addresses, and that seems to be enough. So,
absolutely, it's literally they need to demonstrate that the enterprise is viable and a genuine fundraise.
So if you're in a position to get advanced assurance, entrepreneurs should do it ASAP because it will make things a lot quicker for investors.
Absolutely, and investors will be looking out for it. If you have an opportunity to invest in 2 identical companies, one of which has got advanced assurance already and one of which hasn't, I know where I'd put my money if all things were equal, because I've got a company with which is already down the process of getting EIS approval. So as an investor, I'm looking to maximise my turnaround and my return, and part of that return is the income tax relief on the original investment, and that process will be quicker for a company that's already applied for advanced assurance.
So we only invest in EIS qualifying companies at Angel Academy, but what are some of the reasons a business might not qualify?
Well, thinking about what a qualifying company is, a qualifying company has to have a presence in the UK. It doesn't mean to say it's registered in the UK, but it has to have a presence here, whether that's from directors or it has a processing, it's making things here in the UK. So that's one thing. If a company has no presence in the UK, then it won't qualify as an eligible company. But also it needs to be conducting an eligible trade. And as with most legislation, this is written in the negative. You are an eligible trade if you are not one of the prohibited trades. And prohibited trades are generally professional services, so things like accountants and lawyers. They are property development companies, so anything that's backed by land and buildings. And also things in the regulated sectors like finance and insurance. Those are prohibited trades as far as EIS investment is concerned. But generally, anything that is producing a product, producing a service, generally will qualify.
So just to kind of clarify on something, we've actually invested in several fintechs and insurtech companies, but they provide services rather than the banking bits per se. So Fiscal, Scale, XP, Jove, etc. So they qualify, right? I mean, rhetorical question, because I know that they qualified, but we got our EIS. But that's the distinction there. That's
absolutely right. Companies that are providing, and companies like Fiscal are providing effectively a software as a service. That is a qualifying business. If it's a new startup bank, a new challenger bank, for example, wouldn't be able to qualify because it's part of the regulated financial services.
Okay, all right, thank you. That's good. So we've established that a company is EIS eligible, amongst all the other things we do in our due diligence process, and we've made our investment. What's the process now for claiming the tax relief?
Well, as I mentioned earlier, this is quite entrepreneur-led. It's the company's responsibility to submit the forms to HMRC, detailing who the investors are, detailing how much they've raised, and again, detailing how much or what they're going to spend the money on. HMRC will then review that, and if they are satisfied that it's a qualifying business and all those boxes are ticked correctly, they will issue the company with the EIS 3 forms, and it's these EIS 3 forms that the company then gives to the individual investors, and it's that certificate that allows the individual investor to claim their personal income tax relief.
And when can we make our EIS claims as investors?
Well, it's on receipt of the EIS 3 form. So although you have made an investment in a company that had received advanced assurance, it's not until you get that EIS 3 form back from the company that it has effectively the official stamp of approval that it's qualifying. And then the process is you can either make the claim via your personal tax return. There's a box on the return that talks about how much you've invested in EIS companies and SEIS as well, and we'll come on to those a little bit later. Yes, there's a box on the tax return, or alternatively, you can make a standalone claim. And that's attached to the certificate that you receive, the EIS 3, is a claim form where you can fill in the details and you can send it to HMRC, and you can have the tax relief processed not as part of your tax return, but just as an independent claim.
Okay, and do you have to submit it in the current tax year? I mean,
the investment is qualifies as investment in the year that the shares are issued, the tax year that the shares are issued. But you also have the opportunity to claim tax relief in that year or in the tax year prior to that. So if there is a potential for you are taking a career break or so on, and you don't have any income in the current year, you can claim it against last year's tax liability. And that might be more appropriate for some people. But also carrying it back to the previous year makes the process go faster, because you can apply against last year's tax, and rather than having to wait until this year's tax year is complete and submitting it on this year's tax return.
So are there things that we as investors need to do to make sure that we're eligible?
The most important thing for an investor is to make sure that they have an income tax liability in the UK. It's a tax relief against UK income tax. So making sure that you have paid an equivalent amount of tax, income tax, against to match against the investment that you're making, or the tax relief on the investment you're making. So if you have a £10,000 income investment, you'll get 30% tax relief, which is a £3,000 deduction. So if you've got a tax liability of £3,000 or more, you'll be able to benefit from it. And as I say, if there are circumstances where you don't have that liability in the current year, you could carry back part of it. It doesn't have to be a carry back in full. You can maximize your relief by carrying back some of it to the previous year and claiming some of it in the current year, just making sure that you've got that liability to match against. And having utilizing the income tax liability means that you can imagine I'm a tax accountant. I could talk for hours and I will stop. Having that income tax liability means that you qualify for capital gains tax relief on the exit, and that's the most important part of the relief, effectively. Yeah. If you've got that successful exit, you want to make sure that it's tax free, if at all possible.
Okay, so before we get to that bit, EIS offers very good downside protection as well. So what percentage of your investment is actually at risk? Not that we should be driven entirely by the tax breaks, but you know what I mean.
That's absolutely right. Yeah, there were fantastic upside tax reliefs, but EIS does offer downside tax relief as well. So if the company makes a loss, then you are given some protection. I think on average, the risk is about, or the protection is about 60% of your total investment. So if everything fails, and let's not dwell too much on that at the moment, but if everything fails, you could probably recover about 60% of your investment through the various tax reliefs.
It's useful for now, because we do expect some losses within our portfolio, so it's an important aspect.
And that's why Sarah, you promote having a portfolio approach, isn't it?
Absolutely, yes, absolutely. So if things do go wrong and the company you've invested in fails, what is the process for claiming loss relief?
I think that we've just seen a question pop up there about what counts as a company failure. Let's talk about that first. A company failure would be liquidation, so the actual formal loss of everything. And the company is wound up, and there's no return to shareholders. That would be an exit event, and allow people to claim their loss relief. Administration is a grey area, because administration doesn't actually mean that the company has failed. It just means that the people who were running it beforehand have handed it over to essentially a new set of directors, and it's up to those people to either recover it or realise the assets and so on. So administration doesn't equal business failure. It might be one stage along that process, but it doesn't mean business failure, and it doesn't enable you to exit or to claim your loss at that stage. The process of either liquidation or administration, or however the business fails, can be a long process. It often isn't that short. So there are. So it might be a while before we're able to claim your tax loss following the initial failure of the company.
Okay, so and then if the company So there are other ways that a company can fail in terms of from an investor point of view. So if it sells, but for less than you paid for it, for example, so it hasn't gone into administration or liquidation, but it's just sold for less, you're obviously not making a profit. Can you then claim for loss relief?
Yes, you can. I mean, you've still realized a capital loss on your investment. One of the things that you need to be careful of in that process is if the loss is realized within the first 3 years of your investment, you may end up having to repay some of the income tax relief that you received on the on your initial investment, because you've realized some value out of the disposal within 3 years. But certainly, yes, you can claim a loss on an asset or an investment if you receive less than you paid for it.
Okay.
I think one other thing to consider here is whether or not you can make a negligible value claim. This might be appropriate for a company that's gone into administration, and the administration is taking a while, but there's no real prospect of any return for shareholders. It's a tax claim, so best person to talk to is a tax accountant. I can make some recommendations, obviously, but the best thing to do would be to discuss with your accountant whether or not the company is in a situation where effectively it's become worthless, and you might be able to claim your relief earlier than the formal liquidation process or the formal termination of the administration process.
Okay, thank you. Obviously, we all hope that in our portfolio of angel investments, some will sell for far more than we paid for them. What are the upside protections we get?
Yes, let's talk about the good bit, shall we?
Absolutely, let's do that.
As I mentioned earlier, if you've claimed the income tax relief, and therefore you will get exemption from capital gains tax when you sell the shares, providing that sale takes place after the initial 3-year holding period. So yeah, the upside is whatever the company sells for is tax free. So that's you're certainly not going to get a better offer than that.
No,
which is why EIS is really the way to go for investors.
So we've talked mainly about EIS up until now, but sometimes we see much earlier stage opportunities, and they have SEIS available. What is SEIS?
SEIS is Seed Enterprise Investment Scheme, and the word seed implies that it's seed finance for very small businesses. So this is companies that are effectively less than 2 years old, are in the really beginnings of their trade, and it applies to the first 150,000 of equity finance that is raised from shareholders. Because these are companies that are such a smaller and a much more high risk, the income tax relief is actually 50% rather than 30%. But I'm sure you can probably imagine, the higher risk comes from the fact that a lot of these companies will crash and burn more than their more established EIS rivals.
So quite often we see companies that qualify for SEIS, but they're raising more than £150,000. So there's SEIS and EIS eligibility. How does that work?
Well, a company can raise both financing under both schemes. The important thing for the company process is that the SEIS fundraise must close before the EIS, because you can't obtain finance under SEIS if you've already raised under EIS. So it's perfectly normal for a company to raise under both schemes, close the SEIS scheme fundraise first, and then close the EIS fundraise as little as a few days afterwards. Previously, companies had to demonstrate that they had spent the money raised under SEIS before they could fundraise under EIS, or make an application for the EIS 3 forms. But that's been removed because it was sort of seen to be encouraging companies to spend quickly. Now, most of these companies obviously don't need encouragement to spend quickly, but it was seemed to be distorting the market. So it's quite possible to apply for fundraising under both schemes at the same time.
And then how does the SEIS and EIS get allocated to investors?
It can be first come, first serve. It can be companies can split their investments between EIS and SEIS. So it's really a negotiating point between the entrepreneurs and their investors, how it's allocated.
Okay, all right. And then just so the EIS scheme technically only lasts till 2025. Are there likely to be changes after that, or will it be extended as is? What are you thinking?
EIS has been in existence since about 1985, and so this is a long-established scheme and provides for a safe and consistent approach for investors to invest in startup businesses. I don't see that the government will actually remove the scheme in any way. There may be some tinkering around the edges, and a lot of the scheme has been varied in the past. So income tax relief was increased from 20 to 30% about 10 years ago. I see that there is a future for EIS, and I'm confident that that the scheme will be in existence for many years to come.
That's good to hear. And I think a minister pledged at London Tech Week last week that EIS will be extended. Not that you can believe everything that they say, but it's a good signal, isn't it?
Absolutely.
So just before we move into audience questions, and I see some coming through on chat, but please keep going if you've got questions for Mark. Mark, you've got a really good slide that outlines the main reliefs. Can you just bring that up on screen and talk us through it?
Certainly. So looking at an investment of £10,000, whether you're using the SEIS or the EIS route, we'll indicate whether you get 50% or 30% income tax relief on your investment. But then you're also looking at what happens if the company does fail. You're looking at marginal income tax relief. So the capital loss can actually be converted into an income loss. And here we're talking about a marginal tax rate of 45%, so the additional rate taxpayer. They'll get tax relief on what's left of their investment after the tax relief. So SEIS, you'll get 45% tax relief on your £5,000 investment. At EIS, you'll get 45% tax relief on your £7,000 investment after deducting the income tax you've already received. So as we see that you can de-risk your investment down to 27.5% as far as the SEIS is concerned, and to 38.5% is the capital at risk under EIS. So these are hugely beneficial schemes for investors.
Great, thank you. So we've had some questions from the audience. So first one for you, Mark, is expressions of interest. I think this is around advanced assurance. Do they have to come from UK-based investors to be approved for advanced assurance? So yes.
It would be helpful because obviously it's a UK-based tax incentive scheme. They don't need to be because you can have people who will invest in a company but don't qualify for EIS. But it would be helpful if there are some UK investors, because the purpose of EIS is to grant income tax relief against UK tax liabilities.
Okay, and Julia has asked, how do we receive the tax relief from HMRC?
If you've claimed it via your tax return, then it will be a reduction in your tax liability. And if that reduction means you get a refund, then HMRC will make a payment as part of the balancing reconciliation once you've submitted your return. If you submit a standalone claim, then HMRC will in the good old days, they'll send you a check, but these days they prefer to make a bank transfer. So it's, yes, you'll receive a lump sum back from HMRC.
Great. Okay. So interesting question here. I don't know about, what your knowledge of international taxes are, but how do the UK tax rates compare?
To other countries, I'm not aware of other countries operating a system in this way to the UK. So you get this. This is a uniquely British, perhaps, tax relief to incentivize people to invest in the private sector.
Yeah, I think there are various incentives in other countries, but I think it's certainly the most generous in Europe and the most straightforward, I think. And actually that sort of brings me on to, there's another question from Lucy. What proportion of applicants to HMRC do they give EIS to? I think it's all
so
to do with
what's the success rate?
Yes, I'm not quite sure whether that's for investors or for entrepreneurs.
It's difficult to say because the HMRC don't, as far as I'm aware, don't produce statistics on failed applications, because an application could be rejected but then submitted again, rejected for not containing the right amount of information or so on, which is why it's always good to make sure that your application is checked beforehand, to ensure that it's complete and contains everything HMRC wants to know. So it's difficult to say, but I can say from Hays-McIntyre's corporate team, our success rate's pretty good.
Okay. A question from Chiara, and this is a really interesting one, is what if I've invested in an EIS company that I'd like to get involved with, help them at a strategic level? Is this possible? What level of involvement might negate the income tax relief?
Yeah, that's a really interesting question. It is possible to become involved with the company after you've made the investment, and I would certainly stress the after part of that. If you are connected with a company prior to your investment, if you're an employee or a director, then you are likely to be denied EIS relief because you're not a qualifying individual. That's one who isn't connected with the company. But after you've made your investment, it is possible to become involved. You can even become a director of the company, providing the remuneration that you're paid is commensurate with the job that you're doing, and would be paid to a third party with similar skills. So it's not a way of you effectively receiving back your investment. And those come under what's known as the business angel rules. And effectively, once you've made your investment and you become a director, you've got another 3 years which you can benefit from the EIS scheme for follow-on investments. And then once after you're out of that 3-year period, then any subsequent investments won't qualify for EIS.
Okay, so that's a shorter EIS qualifying period than from somebody who has no formal involvement with the business.
That's right. So anyone who hasn't got any involvement, effectively, there's an unlimited period which you can get EIS investment on for follow-ons. But if you become involved with the business, you become a director, then you're limited to a three-year follow-on period.
Okay, and does a company ever get too old to be eligible for EIS? When does the EIS relief end for everybody?
Yeah, a company can obtain finance under EIS for a 7-year period from its initial. It's actually for its first commercial sale. So once trading has commenced, there's a 7-year period in which companies can obtain EIS finance.
Okay, and then are there any kind of restrictions around family connections to the founders and claiming EIS?
Yes, so you're looking at direct relations, so husbands and wives, parents and children, and remoter issue, and grandchildren and grandparents and so on and so forth. Everyone within that sector is added to your shareholding, so you can't own more than 30% of a company and qualify for EIS. So if you and your partner, or you and your parents own more than 30%, then you don't qualify for EIS.
Okay, all right. And then how does EIS apply if you're paid in equity for your role rather than cash?
You wouldn't get EIS on shares that are issued to you as part of your remuneration package.
Okay, no, that makes sense. And then in terms of being involved in the business, there are some differences, aren't there, with SEIS?
Yes, I mean, for an SEIS company, you can be a director right from the start. Again, the 30% rule applies. So if you are a founder and a founding director, you can't own more than 30% of the company. But yes, you can be an SEIS company and qualify for as a director. It's one of the little anomalies between the two schemes that.
Okay. And does that affect your ability to use EIS in a subsequent round, though? Without getting too far down the rabbit hole.
Yes, I think it does, because you are connected with the company. So you can because of SEIS is written into that legislation. I don't think your investment will qualify for EIS. Although I must admit, I've not looked at it before. But we talked about the business angel rules applying. It might be possible, but I doubt it. It's unlikely.
And are there any typical problems that arise in claims, either for advanced assurance or from EIS relief from investors?
From the entrepreneurs, the typical problem is not providing all of the information that HMRC needs to assess a claim. Now, whether that's at the advanced assurance stage, or whether it's actually when you've taken the investment and you're making the submission for the formal EIS approval post-investment, there are a huge amount of information that HMRC will require to assess the company, and the principal claims, the principal problems and delays in that process are where not all the information hasn't been provided all at once, and there's backwards and forwards between the company and HMRC, and that causes frustration for investors, because all that time is taken and delays the issue of the EIS 3 and getting their personal tax relief. For investors, what's generally the problem? Lack of income tax liability.
UK income tax liability,
UK,
just
absolutely.
to
absolutely. This is a UK tax relief, and therefore UK lacking a UK tax liability doesn't stop you from claiming relief, but it does stop you from benefiting from the capital gains tax on exit, and that's the sting in the tail, effectively.
And on that point, you need to have claimed the upfront relief in order to get the CGT exemption. You can't benefit from EIS retrospectively, can you?
That's absolutely right. And you can't stress this enough, effectively. This is, you have to claim the income tax relief initially in order to benefit from the capital gains tax free exit on success. There is because of the delays that can arise sometimes in issuing the certificates, there is actually quite a long period after your investment in which you can submit that claim form. It's actually up to 4 to 5 years. But remembering, of course, that whenever you make that claim, the investment can only be in the year that the shares were issued, or the year before. So yeah, there is some relief for the long, or some advantage to investors if it does take a long time, but you're still tied to those 2 tax years.
Right. We just have a couple more questions. So the audience has a question to ask. Please put it into chat now, otherwise we'll wrap this up. But I wanted to ask, do the tax reliefs apply to dividend payments you might get from your investment, or is it only exits?
No, it's only exits. So dividends that are paid by an EIS company are fully taxable in the same way that dividends from any company listed on the FTSE stock market would be taxable as well. So the CGT relief only applies to exit. So and income tax is only available on the investment.
Which is why, as investors, we need to aim for exits, not for companies that kind of exist for years and years, that make reasonable amounts of money but can't give us anything tax-free.
Yeah, I mean the return for the investor is the capital exit, not the dividends along the way, as you say.
Right. Thank you very much. And finally, Mark, how can we get in touch with you if we've got any specific inquiries, or with Hays-McIntyre?
Certainly. I'll put my details up on the screen if you like.
That'd be perfect. And it's worth saying at this point that anyone who's a paid up member of Angel Academy gets to have a free session, a free Ask Me Anything session with Mark. So if you are an Angel Academy member and want to spend some time with him, please get in touch with Michelle and she'll set that call up.
Absolutely, be delighted to talk to members. I'm spoke to one yesterday, actually. We were talking about EIS and a potential as an entrepreneur and setting up a company and obtaining tax relief. So yeah, happy to speak to anyone. As you say, Sarah, the hour-long session for Angel Academy members doesn't even have to be about angel investing. It can be about any form of tax. So happy to because my portfolio is personal tax, but also capital tax planning, estates, and inheritance tax as well. So yeah, happy to talk to anyone about anything, as you can tell.
And we've just had one last question in from Laura, which we'll take, because I think it's helpful clarification. So if a business exits at a loss and you get a small bit back of your investment, can you still claim loss relief on the balance? And I think she's saying that the company is less than, the shares have been owned for less than 3 years.
If it's less than 3 years, then that's actually the worst situation, because there is a potential loss of the income tax relief that you had, because you're effectively receiving value back in the way of the disposal. So you may lose your income tax relief, but certainly you can claim a capital loss, and that capital loss could be converted into an income loss. Yeah, there are complications about the loss of the initial income tax relief because of the disposal in that 3-year period.
Right. Okay. All right. That isn't an Angel Academy business, just to be clear. But Mark, well, look, thank you very much for your time in Insights. I just want to quickly kind of talk about next steps for anyone who's on the call and wants to know more about Angel Academy. If you're a founder currently raising investment, then apply to pitch to us via our website. All these links are going into chat as well, so you don't have to copy them down. If you are already or would like to be an angel investor, you'd like to join Angel Academy, please contact Michelle and she will onboard you as an investor with Angel Academy. You could subscribe to our newsletter on Substack. We spend a long time putting that together every month. It's a very good read. Please follow us on LinkedIn. And we have recordings of previous Investor Academy sessions on our YouTube channel. And this one will go up as soon as we finished editing it. Our pitch events will resume now in September, but we do have a couple of other webinars coming up. So a colleague of Mark's from haysmacintyre is going to be talking to us about EMI share option schemes. So these are vital instruments, very tax efficient instruments for founders to incentivize, attract, retain key employees. So very useful for us to know about as angel investors as well as founders. And we also have, we haven't published full details, but please save the date, 13th of July, for the latest economic update. And this comes from the Chief Investment Officer at Investec. And that will probably be everything we do this side of the summer holiday, but hope you'll join us at those events. But thank you very much for dialing in this afternoon, and I hope you enjoy the rest of your day. Thank you again, Mark.
Thanks very much, Sarah.